Okay, so tonight we're going to be talking about why people get denied with good credit scores. DTI is one of the number one silent killers of mortgages or getting approved for a mortgage. Let me back that up. You can have a credit score of 680, but if 50% of your income is already committed to debt, you look really risky. So keep that in mind. So say for instance, if your income is $5,000, then income is considered the money that you earn at work before they take out the taxes and before you bring it home. Your so if you have an income of $5,000 a month and your debt payments is $2,700, that DTI, which is debt to income ratio, equals 54%. That's a denial risk. Lenders can lit, 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 dang, I'm tired. I don't know what's wrong. Lenders care more about capacity, not just your character. So, how much can you hold, and how much will this mortgage break you? Well, I'm not going to say that. Like, can you pay us back? That's pretty much what they want to know. Payment shocks is another thing that people don't realize until they are already there. This is another powerful and rarely discussed thing. Payment shock. If you're paying $900 in rent and now your new mortgage is $2,100, like that is double, a little bit over what double, twice as much as you used to paying. So that's a payment shock. It's a payment shock. Underwriters often ask questions like, can you realistically handle this major jump? Like that's a major jump, especially if you're not used to paying $2,100. If you paying $900, that's a sweet spot. Go to paying $2,100 plus all the other stuff that's tied into this expense. Especially if you don't have a savings. Um, that's a major jump. Another thing that can get you denied is late payments. Even one 30-day late payment within the last 12 months can hurt your approval rates or your approval chances. Mortgage lenders look at recent late payments, frequency, patterns. If you were late 2 months ago, that signals instability. Even if your score look good, they still look at you as a risk. Another big thing that keep people from getting approved for mortgages is insignificant reserves. And when I say reserves, meaning reserves or equals to savings for closing. Like you don't have anything. Well, savings after closing. You don't have anything saved. You literally getting this mortgage without a savings, a cushion. And we all know things happen. And the last thing the lender want you to do is get approved for this home. You get in this home, and then the hot water tank go out. The roof start leaking. Even though like you do the inspection, everything, but life be lifing. And now you have to decide: can I pay? Should I pay my mortgage, or should I get this hot water tank fixed? Should I get this whatever that might come up fixed, or your car might break down? They want to mediate the risk. They want to limit the risk. So making sure that you have reserves after closing is so much, so important. um, Many programs want to see if you have 1 or 2 months of your mortgage payment saved. That shows that you're responsible and you have some cushion. Some conventional loans want more. If your mortgage is $2,000 a month and you have $200 left in the bank, that's a risk. So think about that. Remember, you jumping from $900 to $2,100, and that's a major jump given your income, and plus you don't have anything saved for a rainy day. Another thing, credit mix. Credit mix is very, 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 very important when it comes down to being approved for a loan. Mortgage lenders like to see installment loans like cars, student loans, things that you this installment loan shows that you can handle different type of debts along with like revolving accounts. When I say revolving accounts, I mean like credit cards. That's different from installment loans. So that's two different types of accounts that you have reporting on your credit report. If someone has only one credit card, no installment history, that file is considered thin. So a thin file equals is it it's a risk. It's not a strong file. So you can also be denied just because of that. So make sure before you go apply for a loan that you look over your credit report or you do an assessment of your overall debts and you can see whether you do you have a student loan. Is the student loan is reporting in good standings, or do you have a personal loan like with self? Is it reporting in good standings? Is the payment on it low? Can you balance paying this off along with getting this new mortgage? Do you have a credit card? Is the utilization high on the credit card? If so, you need to bring that utilization down. Remember, I always talk about lenders like to see your utilization being at 30%. I always say keep it 10 because it's cuter and it's safer. For example, say for instance, if you have a $10,000 credit card limit and you use $7,000 of that line of credit, which is the utilization, that automatically puts you over 70% of the rule, which is 30%. So that will drop your score, and it also make you look risky because you out here just swiping away. So let's just recap. Remember, these things get people denied even with a good credit score. DTI, which debt to income ratio, payment shock, meaning that you went from a $900 paying $900 in rent, and then now you have a $2,100 mortgage. That's a major uh, payment. That's a shocker. Recent late payments. No lender want to see recent late payments within the last 12 months. That can hurt your overall approval chances. Insignificant reserves. If you don't have nothing saved in the bank for a rainy day, meaning like if you fall down and break your leg tomorrow and you can't go to work for the next 30 days, how are you going to be able to pay your mortgage? They need to see cushion. At least always have at least 2 months saved up. Credit mix. Mortgage lenders like to see a variety of accounts being reported on your credit report. If they don't see the credit mix, then you have a what you call is a thin file, and that is not a strong file. Denial. If you thinking about applying for a loan and you don't know exactly are you ready, are if so, and you if that's the case, book a free consultation with me. It's 15 minutes. We can do a credit audit. We can look over your file and see exactly what's being reported on your credit report, and also to kind of look at like, do you have the file that they're looking for, meaning the mixed file. If you want more in depth, um, an in-depth overall view of what is you ready or what you need to do, then I also offer a home readiness audit program where we go over your credit report. We look at your overall credit file to see if it's thin and if it's strong. We look at your finances, um, and a whole bunch of good stuff. And then I also provide you with a to-do list and videos to walk you through everything. Then we meet back up. That program is only $49 a month. And I'm also thinking about adding school so that way you can have the support systems in place. If you like more content like this, make sure that you like, share, and follow for more. Drop in the comments below. DTI